Hello, Mark here from Success with Options. Today I wanted to go back and review a iron condor trade that I put on over a series of a couple of videos several weeks back. The trade that we're going to review I actually put on almost a month ago. It was back on the 9th of March. So we're coming up on almost a month since we put that trade on. So I wanted to take a moment to go back and review the trade and actually look at some of the trade adjustments that we've made for the purposes of actually looking at different ways in which we can manage the iron condor trade. Now, if you remember right from the original video, I talked about different things that could happen in an iron condor, knowing that the market could go up, down, or sideways at any given time. We have to consider all of those factors. And so today, what I'm going to do is I'm going to look at that trade as we move through time and see how we've adapted our position to take into account the changes that the market has made. So this is pretty much how the SPY looked when I put the trade on. We were trading right around the 114 level, and we sold a 116, 118 call spread on the top side and a 110, 108 spread on the bottom side to form about a $2 wide spread with a dollar credit. And this was a nice little trade that gives us about a 1-to-1 risk reward ratio, which is perfect for this kind of trade. And as we talked about the different management techniques, we'll actually close that earlier than that. We're not going to hold on for an absolute expiration where both sides expire worthless, but that's kind of the starting point where we target trying to make about $1 on a $2 wide spread. Okay, so as we've moved along in time, I want to kind of just step through the different days, and we can see what happens here as we begin to move forward. And over the next week or so after we put that trade on, we began to start running over into our call spread. And actually about a week after putting the trade on, we were already into our call spread and we were able to close our put spread. So now we're left with a trade that has no put spread and we have a call spread. Now the bias on this kind of a trade has become very skewed. We have a market that's running up strongly, and yet we have a position that is bearishly biased in the sense that we would prefer that the SPY stay below 116. So how do we handle that situation? Well, in the update for that trade, I talked about 3 different ways that we could manage the trade. We could close the position outright for a debit loss. It'd be about a $1.14 debit, which means we'd lose about 20 cents counting the closing of the put side. And that wouldn't be too bad if we wanted to just take our loss completely. What I decided to do was look at a couple of other options and go ahead and execute those. One of those options was we could sell a put spread closer up since it looks like the market's moving bullishly. Remember, we have a 3 contract call spread on, and so one of the things that I could do is sell a 1 contract, let's say, put spread at a higher up level, and I chose to sell a 1 contract put spread at 114, 112. So now we have what's known as a skewed iron condor, where we have more contracts on one side of the iron condor than we do on the other. Now the other thing that we decided to do is close one of the contracts of the call spread. So rather than having 3 contracts on the top side, we have only 2 contracts. So now we have a 2 contract 116, 118 spread and a 1 contract 114, 112 spread. And we've actually used the credit from the 114, 112 spread that we sold to offset the costs of closing the call side, the 1 contract on the call side. So that's kind of one way that we can think about managing that. What this allows us to do is think a little bit about kind of balancing, because we don't really know what could happen. We look at this hard right edge and it looks as if the market's going to go up and it's going to go up forever. And if we were to assume that it was going to do so, we would obviously close the 116, 118 spread and we'd sell 114, 112s like crazy and take advantage of that move. But the truth is tomorrow the market could sell off and we could be back in a situation where we're below our 116 strike and possibly starting to run over our 114 strike. So we have to kind of be careful about all of those things as we think about our trade management. So anyway, as I put this trade on, we begin to move forward in time. And look at that, we start to get a little bit of a sell-off, and it looks like we're going to come down into the range that's sort of our ideal point. I mean, if we were to land in the middle right at 115 on sometime near expiration, that would be the perfect point to land. but I don't think it's going to end up that way. In fact, as we look at it, we're now higher than we were, and we continue to push up. And the market's struggling a little bit here. It's not really making a lot of headway, except a little further down the line. Now, as we get a little closer towards expiration and a little further down, we notice that this is starting to show a little more strength. And so it's time to think about what other courses of action can be employed here. And short of closing the spread altogether, there's a couple of other techniques we can use. One of the techniques would be to buy a calendar spread and put it somewhere in the vicinity of where we think the SPY will land near expiration. And what that does is it helps give us a little bit of a credit boost, not right away because we have to pay a debit, but as we get closer to the expiration point, because we bought a calendar spread where the short strike is expiring in the same month as our spread, and the long strike is 1 month or more out, we actually pick up a little extra premium by doing that. So what I did was right around the 31st of March, what I did was I bought a 117 May-April call calendar, which puts the short strike right in between the long and short strike of the call spread that I sold originally on that spread. We don't know where things are going to stand going into the future. We've got about 15 days or so until expiration, and the market could sell off. It's had a pretty strong run, or it could continue to move up. At this point, we have the calendar spread, we have the put spread. The put spread has lost almost all of its value, and we could close that, but I'm going to leave it on for a little while longer and just evaluate. Now, what I want to do is take a moment and go over to our Analyze tab and kind of look at the effect of our risk graph in adding these various pieces that I've just talked about onto the trade. When we closed out the put spread and we're left with a call spread, this is essentially the risk graph that we're looking at. And our break-even point is currently going to be right around 116.50 or so. And so the first thing that I did, as we talked about, was I went ahead and put on a one contract put spread. And now here's how our risk graph looks. Now notice that what I've done by putting the put spread on is that I've now capped off I've actually added some risk to the downside in the sense that whereas before when we didn't have that spread on, we had a maximum gain even if the market sold off to zero. But now that we've added that put spread, we have a little bit of risk. In fact, we have enough risk that if we go below 112 or so, we hit the maximum loss on the downside, which it looks like it's about $40. Not a big deal, and it's a risk I'm willing to take on this trade. So that's what our position looked like before we added the calendar. Now what I'm going to do is I'm going to add the calendar into the mix, and we'll see how that affects our trade. Okay, so it's not quite so clean of a graph now. What this is basically doing is it pushed out our break-even point a little bit past 117. So once we get past 117, our loss drops quite a bit as we start heading towards 118 and 119, and we reach our maximum loss right around 121, 122. What I want to quickly close with is just the understanding that by putting this position on, we now have more than just the original iron condor. We have a combination of positions, and that combination of positions has given us a risk graph where our maximum gain is going to be right around 115, and from that point either to the upside or to the downside we're going to give up a little bit, but there's a broader range of profit that we've managed to achieve because we have not just one position on, but we've actually aggregated a number of different positions together into a larger position. And of course this doesn't even consider the fact that we've got a number of other positions on in terms of our diagonal spread and so forth. So with that, I'm going to go ahead and close this analysis and wish you a happy trading.